Welcome friends to our course of international business. So, in the last class we had started with the balance of payment, which is our fifth unit, and we just had started understanding what is balance of payment and how it is connected with the the condition, economic condition of any country, right. So, as we said, the balance of payment is nothing but it is the balance sheet of a nation, right. So, which is which is made by the RBI or the central bank in India, right. So, the balance of payment has four components we discussed. The first component which we had covered is the current account, and then we have capital account, the official reserve account, the net errors and omissions. Okay. And the balance of payment equation looks something like this. So, it is the balance of the current account plus balance of the capital account plus balance of the official reserve account plus net error and omissions. So, as of a recent data you can see of 2019, India's BOP at the moment is the current account data was reported at minus 14.316 USD billion in June 2019. So, this records a decrease from the previous number of minus 4.628 USD billion for March 2019. So, in this quarter it has further decreased by another around close to 10 billion US dollars, right. The current account data is updated quarterly, averaging, as you can see here, averaging minus 10.945 USD billion from June 2009 to June 2019 with 41 observations. The data reached an all time high of 317.763 USD million USD in March 2016. So, this is not a million, it is billion actually, and record low of this much in December 2012, right. Now, after the current account we move into the capital account. So, the capital account records all international purchases and sales of assets such as money, stocks, bonds, etc., right. So, the government for example initiates bonds, right, to generate money from the market, right. For example, at this moment the government is trying to generate bonds through the REC for the power sector and other things. We note that any transaction resulting in a payment to the foreigners is entered as a debit and is given a negative sign, right. Any transaction resulting in a receipt from foreigners is entered as a credit and is given a positive sign. So, this is plus because money is coming in and this is minus because money is going out. The capital account involves inflows and outflows relating to the investments, either short term or long term borrowing. So, basically it involves the inflows and outflows from a short term or a long term perspective. So, there are different implications. If it is a short term borrowing, the interest rates would be different. If it is a long term borrowing, it would be different. So, and it has an impact also differently. Largely for long term investments, the long term borrowings are favored, right, and because they are for a long period of time, right. So, and very rarely generally it is all, both of them are important, short term versus long term, but generally any for large investments long term borrowings are favored. Okay. Capital inflow, the loan borrowed, selling of assets or foreign securities, FDI inflows, etc., right. So, this is through how the inflow happens. The capital outflow happens through repayment, buying of foreign securities or assets, FDI outflows, right. A deficit in the capital account means that money is flowing out of the country, indicating that the nation is increasing its ownership in foreign assets. That means, when we say FDI investment outside, suppose India some of the companies are trying to put up a plant in, let us say, Africa. So, that is an FDI being done in the African nation, right. So, there it is a case of the money going outside. So, increase ownership in foreign assets and vice versa in case of a surplus. Okay. Now, financial account has two main subsection. The first is domestic ownership of foreign assets, which is cash outflow. If this increases, it subtracts from the financial account because money is flowing out of the country to purchase the assets. As I said, if you want to put up a plant in Africa, so to purchase that asset, money is flowing out of the country. The second section is the foreign ownership of domestic assets, which is the cash inflow. If this increases, it adds to a country's financial account because money is flowing into the country to pay for the asset. So, for example, if Ford Motors started a plant in Chennai, now that is an FDI investment in India, right. So, money has come in, so there is a cash inflow. Okay. So, capital account or financial account is equal to foreign direct investment plus portfolio investment plus other investments. Okay. These are classified into 3 categories. So, this account for capital or financial account is classified into 3 categories. So, and these are the summation of these 3, right. So, FDI, FPI and other investments. FDI refers to, as we have done in the some other classes also lectures, but still let me go through it. FDI refers to long term capital investment such as the purchase or construction of machinery, buildings, manufacturing plants, etc. So, as the example of FDI is, for example, when any company, as I said, for Ford coming to India, for example, Volkswagen starting its own plant, Samsung starting its own plant in Gurgaon. So, all these are cases or examples of FDI investment in India. So, the assets are being made in India. So, there is a money inflow, right. On the other hand, FPI refers to short term capital investing. Now, these are generally long term, right, for maybe 20 years, 50 years, 30 years, and these are short term, maybe for a year, 2, 3 in the financial assets of a foreign country such as stocks, bonds or financial assets. Now, if you look at for example, the stock market, our Indian stock market is largely affected because of this foreign portfolio investors. Now, what they are doing? They are putting in the money in the market, and as per the fluctuation they would try to make their profits, right. The third is the other investments include bank deposits, currency investment, etc. Okay. So, all these 3 together make up the capital account, right. So, this is the long, this is the short term. Now, what is the difference? Let us understand. For some people they might not be very clear between the difference between FDI and FPI. So, as I said, FDI is a long term investment in, let us say, in assets, right. FPI is a short term investment in maybe the stock market, or you can see, for example, financial assets, right, bonds, stocks, etc., right. Investment is in physical assets, investment is in financial assets. So, this one has to be very clear, right. The aim is to increase enterprise capacity or productivity or change management control. So, what is the aim of FDI? To increase the capacity or productivity. So, Ford wants to, let us say Nike wants to produce its shoes in India. So, they set up an capacity building, right, so that they can produce more, right, and at a cheaper cost. Here the aim is to increase capital availability. So, what is the foreign portfolio investor doing? He is investing in the companies and he is trying to make capital available to the the owners of the company, so that they can utilize it better and increase their profitability. FDI leads to technology transfer, access to markets and management inputs. This is what happens when a FDI comes in, the local there is a technology transfer, the gain and access to new markets for the company who is putting up his own plant in India, for example, and it gets the local knowledge, management inputs. FPI results only in capital inflows. The only thing that FPI does is it helps in giving the money or the capital, and it wants that this money should be used productively by the company owners, and this should increase the profitability of the company, and so that they can also take advantage of it. Okay. FDI inflows into the primary market. So, setting up a plant, constructing a factory, machinery, all this. FPI flows into the secondary market, which we say basically is like the stock market, right. So, we are the FPI flows into the secondary market, means they invest in the stocks of the companies, or maybe some products, right, some financial products. Entry and exit is relatively difficult, because to set up a plant it is difficult, and even to wind up it is also not so easy. But here it is relatively much easier, because it is in terms of capital money, so which you can easily sell off and go back, or you can pump in more money, right. So, the market also sentiments fluctuate with the inflow of money. So, as more foreign investors come in, the market sees it is like a very productive sign, positive sign, and the sentiment of the market improves. But if the foreign players are taking up their money, the retail investors think there is some kind of a danger, and they would like also to come out of the market. So, this also affects the investors sentiments to a very large extent. Now, let us take a case. Now, this is the direct investment, right. This is some portfolio investment, right, other investments in, let us say, in some currency or something. What is the capital account balance? So, the capital account balance is very simple. So, 1560 plus 440 plus 300, that is 2300, right. So, this is the capital account or the financial account. Okay. Now, what is the official reserve account? The official reserve account consists of 4 components: gold, holding of foreign currency by the authorities, reserve position in the IMF, and SDRs. Now, gold we all know. So, gold is kept as a reserve account, right. Then holding of foreign currency. So, how much of foreign currency do we have? For example, India has today the foreign reserve that we say is around the latest, if to my knowledge, around close to 500 billion, right, 400-500 billion. So, how much foreign currency are you holding? So, that affects your trade, because you can the money can, if in case of emergency or something, you can use that money to buy something, import something, or do something, right. Reserve position in the IMF. Now, reserve position in the IMF refers to the reserves paid in by the nation while joining the IMF, right, which the nation can borrow automatically without question asked in case of need. That means, when you join the IMF, you put in some kind of a payment, you make some keep some money. Now, during time of emergency, when the country needs it, it can borrow money from the IMF, right. So, the membership in IMF allows nations to borrow additional amounts subject to the conditions imposed by the IMF. So, there is an X amount, and tomorrow you want X plus more, you can borrow it, but there are certain conditions put by the IMF. The fourth reserve account is the SDR, or special drawing rights. Now, these are international reserves created by the IMF and allocated to the member nations according to their importance in the international trade. It is not same for everybody, it depends on what is your your reputation of the country, right, or your standing in trade. It can be used to settle international payments between monetary authorities of 2 different countries, right. So, let us see this. Now, I have brought one. So, the SDR is an international reserve asset created by the IMF in 69 to supplement its member countries' official reserves. So, the member countries who have become a member of the IMF, in case there is an emergency, it is like a it is like a cooperation. So, if somebody wants money, if he is a member, he can get the money without any problem, right. The SDR was initially defined as equivalent to 0.888671 grams of fine gold, which at that time in 69 was also equivalent to $1. But after the collapse of the Bretton Woods system, the SDR was redefined as a basket of currencies, and gold was not kept as a measure, right. So, what are the currencies? The 5 currencies are the US dollar, the euro, the Chinese yuan, the Japanese yen, and the sterling, British sterling, right. The SDR basket is reviewed every 5 years or earlier in depending on the condition. So, then the current situation today, as of today, the one special drawing right equals to 98.16 Indian rupee as defined by the IMF, right. So, this will vary according this number 98.16, it could be different for other countries in the member countries depending on the standing of the country in the international trade. Now, this is an example which I have brought, you can see. Now, US dollar, euro, Chinese yuan, yen and sterling. So, the weights determined in the 2015 review is what are the weights. As you have a weight for example, in the stock market also you have BSE, NSE which is made on different weights, right. So, different so the weights determined in the 2015 review is the US dollar 41.73, euro 30.93, Chinese 10.92, Japanese 8.33, sterling is 8.09. The fixed number of units of currency for a 5-year period starting from October 1, 2016 is all this, right. So, this is how the SDR is designed. Okay. The last is the errors and omissions. It is a balancing entry. Now, this is the interesting part. So, as we said, the it is a the balance of payment is like a balance sheet made by the RBI, right, or any central bank. So, in order to balance, right. So, we said balance of trade might be favorable, unfavorable, but this has to be necessarily balanced. Okay. It is a balancing entry and is needed to offset the overstated or understated components. Okay. Due to recording of transactions at different places, different point of time and different method of evaluation. The entries under errors and omissions due to deliberate actions and frequently illegal transactions such as drug smuggling, money laundering, etc. Okay. The fact of the BOP, balance of payment accounting system, is that the BOP must balance. So, that is why this comes handy in making that adjustment. So, as we said, current account plus capital account plus errors and omissions plus official reserves is all equal to 0. Okay. Now, let us take this question. If all international transactions were included and measured accurately, then the statistical discrepancy would be A 0, short term capital flows only, positive only, negative or 742 million. So, the answer is 0, right. So, because we say it has to be balanced. Okay. Which of the following would be an appropriate policy to reduce a balance of payments deficit? An increase in the government spending, a cut in the level of indirect taxes, an increase in interest rates or a decrease in interest rate. What should be done? Think about it. The answer is an increase in interest rate. But why it is an increase in interest rate? What happens when there is an interest rate increase, right? So, the savers gain more, but the ones who are using it for some purpose, for them the money flow would be restricted, right. So, to reduce the balance of payment deficit, the government tries to increase the interest rates. Okay. The BOP statement of a country indicates whether the country has a surplus or a deficit of funds. We have seen that. So, we have discussed on this also. So, balance of payments deficit, balance of payments surplus. So, now this person is not very happy and here the people are very happy, as if it seems like that, right. Now, let us look at the deficit. The country imports more goods, services and capital than it exports. You are importing more. It must borrow from other countries to pay for its imports. It does not have the money. So, it must borrow. In the short term, this fuels the economic growth. In the short term, the economic growth happens, but in the long term it will have to go into debt to pay for the consumption. So, this is what happens when there is a balance of payment deficit. But when there is a balance of payment surplus, the country exports more than it imports. The country provides enough capital to pay for all the domestic production. So, the country has enough capital, right. A surplus boosts economic growth in the short term. So, if there is a surplus, economic growth would happen, right. In the long run, it becomes too dependent on export driven growth. So, that is not also very good. So, there has to be a balance. In the long run, it becomes too dependent on export driven. So, today China for example is a highly export driven growth economy, right. So, if something wrong would happen to the on the export side, as currently the US China cold war is going on, right. So, this economic crisis that can happen can have a devastating effect on the Chinese economy, because they are heavily dependent on the exports, right. So, let us take this example, let us take a case. So, these are some of the particulars and these are the amounts, right, in crores. So, merchandise export 100, merchandise imports 125, tourism exports 90, insurance imports 80, income receipts from abroad 110, interest payment to foreigners 150, increase in domestic ownership of foreign assets 160, increase in foreign ownership of domestic assets 200. Assuming that unilateral transfer equals 0, right, find the merchandise trade balance. net exports of services, the current account balance and the capital account balance. I would request you to, before I move into the next slide to show you the answer, kindly try it on your own, and whatever you have understood till now, you try to solve this problem and come up with the answers for the same, right, for these. Try to do it and then automatically I will take you over. Okay. So, let us move to the solution, right, and you can check whether you have done the same or not. So, merchandise trade balance or net export goods is equal to export minus import. So, which is how much? 100 and this is 125. So, exports was 100, imports was 125. So, you imported more. So, that is minus 25. Okay. Net export services. So, let us see how much it is, 90 minus 80. So, tourism exports, insurance imports, right. So, 90 minus 80, 10, right. Net income from abroad. So, income receipts 110, payments 150, right. So, this is minus 40. So, the current account balance is equal to merchandise trade balance plus net export services plus net income from abroad, right, plus unilateral transfers, right. So, we said it is 0, right. So, that means it is minus 55. So, the current account balance of at this moment is minus 55 crores, right. Capital account balance, what happens, is equal to the foreign ownership of the domestic assets, which is cash inflow, minus the domestic ownership of foreign assets. So, money has gone out, cash outflow. So, which is, let us say, you see increase in foreign ownership of domestic assets is 200. This is money come in because foreign ownership of domestic assets. So, foreign ownership has money has come in, here money has gone out, right. So, this is yes. So, if you look at it, cash inflow is 200 and cash outflow is 160. So, the result is 40. So, I hope you have been able to do it with me, right. Now, various causes of disequilibrium in the balance of payment. Now, why there is a disequilibrium in the balance of payment, how it affects and what happens. Few factors affect the balance of payment, right, they create a disequilibrium. The first one being the inflation. Now, as we all understand, what is inflation? Inflation is the rise in price of the basic goods and services, right. So, inflation phenomena, that is higher wages, higher cost of raw material, wages etc., makes the exports costlier and decrease in exports. This leads to a deficit in the BOP, the balance of payment, right. So, when the costs of goods are increasing, the wages are increasing. So, automatically the cost of production will also increase. So, now you that will lead to a decrease in the exports, right. So, that making because it becomes costlier, right. So, that leads to a deficit. Then another point is the exchange rate fluctuations. The exchange rate also affects the BOP. Now, what is it? Now, how does the exchange rate affect the BOP? When the value of currency of a country increases, imports become cheaper. Now, let us understand this. In fact, many countries have adopted this as a strategy in order to increase their exports, one being Japan, the other being China, which comes to my mind very easily, right. Now, what happens here is that when the currency of a country when the value of the currency of a country increases, imports become cheaper. Thus, the value of imports rises and the value of exports falls, which contributes to disequilibrium. You see, for example, when currency devaluation happens, so the the dollar, with the same amount of dollar, now you can buy more. So, because you can buy more, so exports increase, right. When the currency is devaluating, export will improve, right, export will improve, export will improve. But when the currency is appreciating, suppose in comparison to the dollar, let us say with the same amount of dollar they can buy less. So, export will fall, export will fall, but import will have a positive effect, it will have a positive effect on the import. Here on the other side, when it was devaluating or the currency was depreciating, the export was growing, but the imports were becoming costlier in this condition. So, exchange rate fluctuation has a very large impact, Population growth. Uncontrolled growth of population leads to fall in the aggregate demand. Now, what is aggregate demand? We have seen is aggregate demand is the consumption plus investment plus government expenditure plus net exports, right. So, this is the export minus import basically, and thus BOP becomes adverse. So, when there is an uncontrolled population growth, there is a fall in the actual, or it is sometimes called actual demand also, aggregated demand or actual demand. So, this falls, right. So, and thus the BOP becomes negative or adverse. Demand reduction. A fall in demand for a country's goods abroad will also reduce exports, thereby causing disequilibrium. Now, for example, you see with westernization, many of the local products or the designs that were made by the local industries went out of demand, and the products, the foreign products from other countries like Italy, in for example, in certain products from different countries, purses, perfume and all, they were heavily in demand. So, because of this, what happened? Because of the change in style, tradition, habits of people, there can be a fall in the demand for the local goods and a rise in the goods of the foreign companies. So, this also can lead to a disequilibrium of the BOP. The next point is the cost of public relations function. Now, what it says? New independent countries have to set up embassies and missions abroad to create and maintain good relationship with other nations. This is a huge expenditure, and this also distorts the BOP unfavorably. Then social factors. People of an underdeveloped country tend to imitate the consumption pattern of the people of developed countries. So, due to such psychology, the imports of the foreign country increases, which again triggers disequilibrium. Now, interestingly, this has happened largely with India also. But on the other side, if you see what happened to Japan, Japan's automobile sector saw a serious growth and huge improve in footfall in their business, just because when the currency devalued, Japanese cars were becoming cheaper to the US owners, and as a result of it there was a huge demand, right. But when it comes to consumption basic goods, for example style, luxury goods and all, so when Indian economy was growing, there was a demand for those luxury goods and kind of style oriented goods, and the young generation which had a larger earning or purchasing power, they wanted to go for the foreign goods instead of the Indian localized goods. So, as a result of it, this also led to a disequilibrium. Okay. Finally, is political aspects. So, political instability, non-cordial international relations can also have very adverse impact. So, partition, unification of nation, all these can have a very significant effect on the BOP. Now, let us look at the implication. So, what is its effect? It is possible for every country in the world to have a trade surplus, right. If international trade is voluntary, then it is difficult to argue that deficit countries are harmed and surplus countries benefit. Deficits are not inherently bad, nor are surpluses necessarily good. One has to understand that the balance of payment, from the balance of payment, that sometimes the argument is that deficit countries are in a bad situation and the surpluses are in a positive or a good situation, but it is not necessarily true, right. What happens if the country has a current account deficit? The country must borrow, right, to the rest of the world to finance the current account deficit. As foreigners accumulate domestic securities, the domestic currency value falls, which in turn raises net exports, which I just explained, and consequently the income. So, which Japan and China had done very largely. In addition, domestic interest rates rise, which in turn lowers the consumption and investment spending. So, this has vicious effect on the economy. The increase in national income relative to spending will reduce the current account deficit, right. So, this is what happens. So, I hope you have understood from this lecture of today that what balance of payment is, what are its implications and how it affects any economy. So, all these things we discussed today. I think when you again go back to the lecture and listen to it, you will have more questions, maybe more clarity will also come. So, in case you have questions, you can always ask me later on. Thank you very much.